Chapter 1. The Money Nobody Could See Leaving. There was a moment, quiet, unremarkable, when something shifted. It wasn't announced on the evening news with a graphic and a countdown clock. It didn't come with a government letter or a bank notification. It arrived the way most financial damage arrived, slowly, then suddenly, in the form of a grocery bill that felt slightly heavier than it did 6 months ago. People had started noticing things. The tank of gas that used to cost $45 was now costing $62. The rent that had been stable for 2 years had crept up again. The savings account that was supposed to be growing, the one with the automatic deposits set up with so much discipline and hope, somehow felt like it was standing still, or worse, quietly shrinking in real terms. Nobody connected it to Iran. Why would they? Iran was far away. Iran was a news story. Iran was something politicians argued about in rooms that ordinary people never entered. It felt abstract, distant, the kind of problem that belonged to generals and diplomats, not to families sitting at kitchen tables trying to figure out why their paycheck wasn't stretching as far as it used to. But the connection was real, and it had been running silently beneath the surface of everyday American financial life for longer than most people had realized. This was the story of how a conflict thousands of miles away had already begun reaching into the pockets of people who never once thought about the Strait of Hormuz, the price of Brent crude, or what military tension did to the psychology of global markets. It was a story about money, about how it moved, and about who it moved away from. Chapter 2. The Strait That Controlled Everything. There was a narrow body of water at the mouth of the Persian Gulf. It was called the Strait of Hormuz. It was, by most measurements, only 21 miles wide at its narrowest point, and through that 21-mile corridor passed approximately 20% of the world's entire oil supply. That number was worth sitting with. 1/5 of all the oil that the entire world consumed, every plane, every ship, every factory, every heating system, every plastic bottle, every pharmaceutical package, passed through a channel so narrow that a moderately sized aircraft carrier barely had room to turn around. When tensions rose between the United States and Iran, that strait became the most watched piece of water on the planet, because Iran had repeatedly signaled over decades that if pushed far enough, it had both the intention and the capability to close it, or at least threaten to. And markets didn't wait for things to actually happen. Markets responded to the possibility that things might happen. This was something that most people never fully grasped about financial systems. They assumed markets moved on facts. They didn't. Markets moved on fear, on speculation, on the collective anxiety of traders and hedge funds and sovereign wealth managers who were all simultaneously asking the same question. What if? What if Iran blocked the strait? What if tankers stopped moving? What if oil, which was already tight from OPEC production cuts, became suddenly catastrophically scarce? The answer to those questions was always the same. Oil prices went up. And when oil prices went up, everything else followed. Chapter 3. The Invisible Tax on Everything. Oil wasn't just gasoline. That was the part most people had never been taught. Oil was the foundation of the modern economy in a way that went far beyond what people put in their cars. It was in the plastic casing of every phone. It was in the fertilizer that grew the food. It was in the transportation cost built into every Amazon package. It was in the electricity bill, the airline ticket, the synthetic fabric of the shirt someone bought on sale. When oil prices rose by 20%, which had happened multiple times during periods of Middle East tension, it didn't just mean a more expensive drive to work. It meant a slow, grinding increase in the cost of almost everything that touched modern life. Economists had a word for this: pass-through. The increased cost of energy was passed through to consumers at every stage of the supply chain. The farmer paid more to run the tractor and buy the fertilizer. The trucking company paid more per mile. The grocery store paid more to cool the shelves. And at the very end of all those pass-throughs, the family standing at the checkout counter paid more for a cart full of food. They didn't see a line item that said Iran war surcharge. They just saw the total. And the total was quietly, steadily, invisibly higher. For the average American household, the federal government's own data had shown that energy-related expenses, directly and indirectly, touched somewhere between 8 and 12% of total household spending. For lower-income families, that share was even larger because a bigger portion of their income went toward necessities. A sustained 20 to 30% increase in oil prices, held for 6 months to a year, had historically translated to several $100s per year in additional costs for the median American family. That wasn't theoretical. That was what the data had shown repeatedly across multiple conflict cycles in the Middle East. The tax was real. It just didn't appear on a tax form. Chapter 4. What fear did to the dollar. There was another mechanism working alongside the oil price shock. It was subtler and in some ways more damaging. It was called inflation expectation. When people and businesses started believing that prices were going to rise, they began to act in ways that made prices rise. Businesses raised prices preemptively to protect their margins. Workers asked for higher wages to keep up. Landlords raised rent because they believed their own costs were going up. And somewhere in that loop, inflation stopped being a measurement and started being a self-fulfilling prophecy. The Federal Reserve, the institution responsible for managing the value of the American dollar, watched inflation expectations the way a doctor watched a patient's temperature. Because once expectations became unanchored, once people genuinely started believing that the dollar in their hand would be worth less tomorrow than it was today, the Fed had very few comfortable options left. It could raise interest rates, which it had done, aggressively. Higher interest rates meant more expensive mortgages, more expensive car loans, more expensive credit card debt, more expensive small business borrowing. It meant the dream of home ownership, which had already been slipping out of reach for an entire generation, slipped further. It meant the family that had been saving for a down payment watched as the monthly payment on the house they were targeting rose by $400 or $500 a month, not because the house got more expensive, but because the cost of the loan did. And the savings account? The one that was supposed to be the safe option? Inflation, running at 4 or 5 or 6%, quietly consumed real purchasing power, even when the nominal balance stayed the same or grew slightly. A savings account earning 2% in a 5% inflation environment was a losing proposition. The number on the screen went up. The actual value of that money, what it could buy, went down. That gap was where ordinary people's financial futures quietly dissolved. Chapter 5. The Stock Market and the Illusion of Safety. There was a story that had been sold to the American middle class for decades. It went something like this: if the stock market goes up, things are good. If it goes down, things are bad. The 401k became the central instrument of retirement security for most working Americans. By the early 2020s, roughly 60 million Americans held retirement savings in 401k accounts. The vast majority of those accounts were invested primarily in stocks, specifically in funds that tracked major indices. When geopolitical tensions spiked, When news broke of airstrikes or diplomatic collapses or threats to close the Strait of Hormuz, markets reacted. They had always reacted. The volatility index, known on Wall Street as the VIX and sometimes called the fear gauge, had historically spiked during major Middle East conflict escalations. In the weeks following significant Iran-related events, sanctions announcements, tanker seizures, military incidents, the S&P 500 had experienced periods of elevated volatility and, in some cases, sharp short-term declines of 3 to 7%. For someone with $200,000 in their retirement account, a 5% decline meant $10,000 gone. Not permanently, necessarily, but gone in that moment. Gone in a way that aged a person who was checking their account balance and trying to calculate how many years they had left until retirement. And for older Americans, those in their late 50s or early 60s who didn't have the luxury of waiting out a market recovery, geopolitical shocks were not abstract events. They were changes to retirement timelines. They were decisions about whether to delay retiring. They were quiet sacrifices made in response to headlines generated by decisions they had no part in making. The market had been designed as a wealth-building tool, but it had also become a transmission mechanism, a way for global instability to reach directly into the retirement savings of people who had spent decades trying to do everything right. Chapter 6. The defense spending reality. There was another layer to this that almost nobody talked about in personal finance circles because it didn't feel personal. But it was. Military conflict, or the sustained threat of it, was expensive. The United States military presence in the Middle East, including naval deployments in the Persian Gulf and Arabian Sea, logistical support, intelligence operations, and diplomatic machinery, carried a price tag measured in hundreds of billions of dollars over time. That money came from somewhere. It came from the federal budget. And the federal budget was, at its core, the collective financial resources of American taxpayers. This wasn't a political point. It was an accounting point. When the federal government ran large deficits, which it had been doing consistently, and which expanded during periods of heightened military activity, it borrowed money. It issued treasury bonds. And that borrowing had consequences for the broader economy. Large government borrowing competed with private borrowing for available capital. It put upward pressure on interest rates. It contributed to the debt load that would, at some point, need to be serviced by future revenue, which meant, ultimately, future taxes or future inflation, or both. The Congressional Budget Office had repeatedly highlighted the long-term fiscal pressure created by sustained defense spending commitments. Over the course of a generation, the accumulated cost of Middle East military engagement was estimated by various economists and researchers to have run into the trillions. Trillions that might have gone toward infrastructure, or education, or debt reduction, or tax relief. Instead, they were embedded in the price of geopolitical commitment, a price that was distributed across the entire economy in ways too diffuse and complex for any individual to trace back to their own financial situation. But diffuse didn't mean absent. The cost was real. It was just spread so thin that it became invisible. Chapter 7. Who paid the most? Not everyone bore this burden equally. That was one of the uncomfortable truths sitting at the center of the story. The wealthiest Americans had always had tools that acted as buffers during inflationary and geopolitical shocks. They held real assets, real estate, commodities, inflation-protected securities, international holdings, that tended to hold or even increase their value when the dollar weakened or consumer prices rose. Oil companies, for example, were having a very different experience during a period of elevated oil prices than the family filling up their car. The same price spike that cost American families hundreds of dollars per year added billions to the quarterly earnings of energy companies. ExxonMobil, Chevron, and others had posted record-breaking profits during periods of oil price elevation, profits that flowed primarily to shareholders, which meant primarily to people who were already wealthy. This was not a conspiracy. It was simply how the financial system was structured. For the bottom 50% of American households by wealth, financial assets, stocks, bonds, real estate equity, represented a tiny fraction of their net worth. Their wealth was predominantly their income, their wages, their ability to work. And wages, historically, had been slow to keep up with inflation. Real wages, wages adjusted for purchasing power, had stagnated or declined during inflationary periods, even when nominal wages rose. Workers were getting raises that felt like raises, but buying less with every dollar they earned. The people who felt the Iran conflict most acutely in their financial lives were not the people watching from boardrooms. They were the people watching gas prices at the pump. The people choosing between name brand and generic. The people doing the math on whether they could afford to take a flight to see family for the holidays. They were, statistically, most Americans. Chapter 8. The Psychological Cost. There was a dimension of this that wasn't captured in economic statistics. It was the psychological cost. The chronic, low-grade financial anxiety that had settled into the daily lives of working Americans. Financial psychology researchers had documented extensively the cognitive and emotional toll of financial insecurity. It wasn't just stressful, it was cognitively impairing. A landmark study published in the journal Science had found that financial worry consumed cognitive bandwidth in ways that reduced effective decision-making ability, creating a kind of mental tax that was separate from and compounding upon the material financial stress. People who were worried about money made worse financial decisions. They were less able to plan long-term. They were more susceptible to short-term thinking. They were more likely to take on high-interest debt, less likely to invest, less likely to save consistently. And geopolitical uncertainty, the kind generated by an ongoing, unresolved, periodically flaring conflict, had been shown to increase general financial anxiety, even in households that weren't directly impacted by the specific economic mechanisms at play. The news cycle itself was a stress delivery mechanism. Every headline about military activity, about oil supply disruption, about inflation fears linked to Middle East tension, added to a background noise of financial worry that quietly degraded the quality of people's financial thinking and decision-making over time. The system didn't just take money through oil prices and inflation. It took it through the compounding effect of fear-driven financial behavior, the person who cashed out their investments at a market low because the anxiety had become unbearable, the person who stopped contributing to their retirement account because the future felt too uncertain, the person who borrowed at high interest rates to cover expenses during an inflationary period rather than waiting and planning. These were not failures of character. They were predictable human responses to sustained stress operating within a system that almost nobody had been given the tools to fully understand. Chapter 9. The Cycle That Repeated. This wasn't the first time this had happened. That was perhaps the most sobering part. The 1973 Arab oil embargo had triggered an energy crisis that sent inflation in the United States to double digits and caused a recession. The Iranian Revolution in 1979 had driven oil prices to levels that, in today's dollars, exceeded the peaks of subsequent decades. The Gulf War in 1990 had caused a brief but sharp oil price spike that contributed to the 1990-91 recession. The Iraq War, beginning in 2003, had coincided with a sustained oil price increase that gradually eroded purchasing power throughout that decade. Each time, the pattern had been roughly the same. Conflict or tension in the Middle East. Oil prices rise. Inflation follows. The Federal Reserve responds with interest rate increases. Ordinary households face higher costs, reduced purchasing power, and tighter credit conditions. Wealthier households adjust through diversified assets. The gap widens. And then the cycle quieted. Oil prices stabilized. Inflation moderated. Life returns to something like normal. And most people moved on without ever having connected the dots, without ever having built the financial resilience that would help them navigate the next time the same pattern emerged, because there was always a next time. The geopolitical reality of the Middle East, the structural dependence of the global economy on fossil fuel energy, and the role of the United States dollar as the world's reserve currency, these were not problems that were solved between one conflict cycle and the next. They persisted, creating the conditions for the pattern to repeat. Financial advisors who paid attention to history had always known this. The people who built wealth across generations had always known this. The knowledge existed, it just wasn't widely distributed.
Chapter 10. What the realization changed. There was a different way of seeing personal finance once this connection was understood. The decision to keep all savings in a low-interest account, for example, looked different when viewed through the lens of geopolitical inflation risk. The historical evidence suggested that during periods of sustained geopolitical tension, cash savings lost purchasing power at an accelerated rate. This didn't mean abandoning savings accounts, it meant understanding their limitations and their role within a broader strategy. The decision to have no inflation protection in a retirement portfolio looked different. Investments in commodities, Treasury inflation-protected securities, TIPS, real estate, and energy-related assets had historically performed better during inflationary periods than purely nominal bond holdings. These weren't exotic instruments, they were widely available in standard brokerage and retirement accounts. The decision to carry high-interest debt into a rising rate environment looked different. Understanding that geopolitical shocks could accelerate Federal Reserve rate increases, which had happened visibly and rapidly in recent years, gave urgency to the task of reducing variable rate debt loads. The decision about housing, whether to lock in a fixed-rate mortgage before rates climbed further or to wait, looked different when the relationship between Middle East tension, oil prices, inflation, and Fed policy was understood as a coherent chain rather than a set of disconnected news stories. None of this was simple. Financial planning never was, but it was different, meaningfully different when the hidden connections were visible. When the mechanisms were understood, choices became more informed, not perfect, but more informed. Chapter 11. The System That Remained. The realization didn't come with a solution. That was important to understand. The structural dependence of the American economy on Middle Eastern oil had decreased over time. The shale revolution had made the United States a significant oil producer, and renewable energy was growing. But the interconnectedness of global oil markets meant that even domestically produced oil was priced on global benchmarks. A disruption in the Strait of Hormuz still moved prices at American gas stations and American grocery stores, even if not a single barrel from Iran or the Persian Gulf touched American soil. The dollar's role as the global reserve currency meant that American monetary policy continued to be shaped, in part, by the need to manage global financial stability, a role that came with both privileges and constraints. The political economy of defense spending, of Middle East alliances, of the complex web of interests that kept American military assets positioned in the Persian Gulf, these were not going to be resolved quickly or cleanly. The system that had been created over decades, the petrodollar system, the mutual defense arrangements, the intelligence and diplomatic infrastructure, was deeply entrenched. It had served powerful interests for a long time.
it wasn't going to disappear, which meant the pattern was going to continue. The connection between geopolitical tension in the Middle East and the financial lives of ordinary Americans was not a temporary malfunction, it was a feature of the architecture. Understanding it was the only real protection available to people who didn't have armies of financial advisors or the diversification options of the ultra-wealthy. The map had always existed, it had just never been handed to most people.
Epilogue: The weight of knowing. There was something uncomfortable about understanding this clearly. It was easier in some ways not to see it, to believe that the price at the gas pump was just a local phenomenon, that the inflation on the grocery receipt was just a corporate decision, that the retirement account fluctuations were just normal market noise, that the war was over there and the money was here, and the two things had nothing to do with each other. But they did. They always had. And the people who had understood that, who had built their financial lives with that understanding as a foundation, had navigated the turbulence differently, not without difficulty, but differently. They had held inflation-resistant assets during the bad periods. They had locked in fixed rates when rates were low. They had kept their debt light when they sensed tightening was coming. They had thought of their personal finances not as isolated from the world, but as embedded within it, shaped by it, and responsive to it. That kind of thinking was available to anyone. It required no special access, no particular income, no financial degree. It required only the willingness to see the connections that the system itself had never been particularly interested in helping ordinary people see. The war was thousands of miles away. The bill was arriving every month. And understanding that, really understanding it, not as an abstraction, but as a lived financial reality, was the beginning of something different. It was the beginning of asking better questions, of making different choices, of seeing the full picture rather than just the part that was framed and presented. The system was still there. The pattern would continue. But a person who could see the pattern was in a fundamentally different position than one who could not. And that realization changed everything.